What's up everyone, it's Karthik with MoneyVest. So in this video, we are going to be talking about the jobless claims, unemployment numbers, as well as the S&P 500 with regards to recession cycles. So I spent pretty much the entire day compiling all this data for all of you, and I just want to be very clear that this is a little bit incomplete for the very reason that I've not really included the rate cycles here at the moment, because I need to include for that data. I have it in a separate spreadsheet over here. As you can see, that I've got the previous rate hiking and cutting cycles, as I've mentioned in my previous videos. But in this video, we're going to go over this data over here. This is the table that I've compiled together that includes for both the market cycle and the recession cycle. So there's really just three cycles that we're trying to compile together, and that's a lot of data, a lot of different dates, and a lot of different endpoints. So I'm sure you can imagine how difficult and complicated things get, but we're really trying to understand the combination of the rate hiking cycle with the rate cutting cycle, as well as the recession cycle and the market cycle. So in this video, I've only really just compiled two of those three, which is the recession. So we've got the starting date for the recession, the ending date for the recession, the duration of that recession, and then we've got the market cycle, which essentially tells us the peak for the markets during the times of recession. And what was that peak date? The trough, basically what was the low, what was the bottom for the market, the actual bottom date, the duration for the entire sell-off in terms of months and days, and then we have the change, the percentage change from the peak to trough, and then back to trough to peak here. This is not necessarily peak, but this is back to sort of the level before we actually saw a bigger decline in the S&P 500 once again. So S&P 500 dates back to 1923 when Standard & Poor introduced the index covering 233 companies, and the index as it is known today was introduced in 1957 when it was expanded to include 500 companies. So we're going back as far as 1929 to understand both the performance of the recession, the economy, the markets, S&P 500 as well. So that's what we're discussing. And there have been as many as 48 recessions total, going back as far as the Articles of Confederation. And this is from back in the 1800s. We're only going back as far as 1929. And since 1929, we have witnessed about 15 or 12 recessions. So this right here, let's just do a quick count. And we have experienced just over 15 recessions since 1929, and the 30 of them actually came in prior to 1929, so that's actually quite crazy to think about. But that right there is the cyclicality of the economy in the United States. Now this right here is a very, very smart question and comment from Thomas from one of my previous videos, and I highly recommend that you check that out as well, because it's going to give you a bit of an understanding and an idea of recessions with respect to the rate cutting cycle. And you'll notice that the last 4 times when we have seen the Federal Reserve cutting interest rates, they've actually cut rates first, and then a recession has followed. And that was discussed in my previous video, and I highly, highly recommend that you check out that video to get a bit of a context and a more perspective on these 3 cycles that we are discussing in tandem with each other. So Thomas says the last 4 times that we have seen the first rate cut, recession has followed later. In other words, the rate cuts have come in prior to the recession starting. 6 out of the 7 first times, since going back as far as 1920s, the rates have been cut after the recession was already there. Why this change in pattern? Maybe because they would have learned from history, and now they are trying to ward off a recession earlier? Question mark. Very, very smart question, and that exactly is the whole idea. If you come back to our rate hiking cycle, what you'll notice that this is the data that I presented in our previous video, and you'll notice that this is a negative number, meaning that the economy fell into a recession before we actually started to see a rate cut. Rate cuts essentially happened after we saw a recession, right? So that's a recession first, cut later. Recession first, cut later. Recession first, cut later. That was kind of like the trend going back as far as 1950s and 1960s. But if you take a look at the last 4 times, we've actually fallen into a recession. We fell into a recession after the rate was cut. So in other words, we saw the cut first, recession later. cut first, recession later. So that was the whole idea behind that question. Again, Thomas asking why this change in this pattern. And I essentially commented back with a response saying, great observation. Yes, my guess is that the economy has become more sensitive to interest rate hikes because of the level of debt, as we have seen significant amount of fiscal deficit grow, and the national debt has also increased significantly to over 35 trillion. So in the past, the Fed did not intervene as much, and they let the pain go on for some time before indulging in rate cuts. So I think it's really obvious to understand that the Federal Reserve let the economy go on its own. It was a free market for the economy to kind of feel the pain before they actually indulged into rate cuts and before intervening. And I also believe that in more recent times, the reason why we're seeing a bit of a switch in this pattern is because there's been a lot of political influence on rate cuts as well. In my opinion, because of the so much political influence, depending on who's in the office or who's the party that's contesting the current party in the office, there's been a lot of political influence for the Federal Reserve to come under a lot of pressure to intervene and fix the economy quickly. So every time there is even the slightest of signs that the economy might be entering a recession, the Federal Reserve steps in to cut interest rates before the economy is into a recession, right? So that's why the rate cuts have come in prior to a recession. And that was the whole idea behind that video. So I definitely do recommend that you check out that video. On average, we have seen a rate cut about 164 days or just under 6 months before the recession actually happens. So if you're expecting a September rate cut in 2024, you tag on close to 6 months from September. We're expecting the end of first quarter, beginning of second quarter 2025 for the recession to begin. Now, market is also a very, very good indicator for when there is going to be a recession or not. So if you come over to our spreadsheets, so I forgot where that spreadsheet is. So this is right over here. And I'm not going to go over in too much detail into this entire spreadsheet. Maybe we can go over some instances. There are quite a few overlaps, and there's also times where the markets have dropped, let's say 23% without even having a recession. So every time you see a black over here, that means the markets fell a little bit over 14, 15, 20, 30% without an accompanied recession in the U.S. economy. Every other time, the sell-off in the stock market, which is S&P 500, was accompanied with a recession in the U.S. And what we have really found from our analysis, and if you just remove for the first 3 instances, and the reason I do that is because it's really going to skew the data significantly because of the massive negative numbers here. So I've got 2 questions that I'm trying to answer with this analysis. Does the market top prior to a recession starting, right? In other words, does the market actually create a top before a recession begins? In other words, is the market's forward looking to actually create a top before the recession's even started? And does the market bottom prior to a recession ending, right? Does the market actually create a bottom or a floor before the recession's even over? Okay. And so what we've done is, we've essentially taken the 2 dates and we've subtracted them to really understand whether this number is positive or negative. So if you, for example, take a look at this, negative 31. So what I've done here is that I've taken into account the start date of the recession and then subtracted it with the peak date for the S&P 500. So you'll notice that August 1929 was the start of the recession, and September 1929 was the peak for the S&P 500. So recession in this case started a month earlier than the actual peak in the market. So if this number is negative, recession started earlier. Okay, so negative equals recession started earlier or before market top. If it's positive, right? If it's positive, markets topped before recession started. So if you take the average of all the prior recessions and market tops and you average them out to better understand what's really been the true average for the markets and are they doing a good job in anticipating recessions, we come down to a number that's 158 days. This is exactly the number that I was able to find for the rate cuts. And that's just over 5 months. And it's a positive number. So if you come back to what positive means, markets have topped before a recession started. So even before the recession has started, the markets have topped by an average of 5 months. That's what this analysis basically represents. And that 5 months is almost identical to the 5.5 months that we witnessed from the rate cut cycle. So both of these data points, both of these analyses really do suggest that a recession is possible if indeed we saw the July 11th as being the all-time high as the top for the market, and September coming in with a rate cut. We could expect 5 months from that timeline, somewhere between February and March of 2025, to be a timeline for when the recession actually begins in the US. Something to keep in mind. Now, there is still a 25% probability that we actually witness a soft landing. So this was, again, an analysis that I did in my previous video where there is a 75% probability for a hard landing versus 25% for a soft landing. Something to keep in mind. And then if you come over to the second data set, or the question that we're trying to ask, does the market bottom prior to a recession ending? So in other words, does the market also is forward looking to a point where it actually forms a bottom before the recession is even over? And same thing is true for this. So we're taking into account the trough date, which is the market bottom, and also the ending date of the recession. So what I've done here is I've essentially taken into account the ending date for the recession minus the trough date. So for example, March 1933 was the ending of that recession. However, the markets had already bottomed in June of 1932. So they have already bottomed prior to a recession ending. So that is a positive number. So in this case, a positive number essentially means market bottoms before recession ends. And a negative number is going to tell us that market, or essentially recession ends after market, or recession ends before market bottoms, right? So just want to be clear here. I'm going to double check the data here because it is a bit more confusing. Market bottoms here. There we go. So if it's a negative number, like for example this minus 1400. So if you come over to this data point, you'll notice the end of the recession was 1938, and the markets didn't bottom until 1942. So recession ends before a market bottoms, right? That's going to be a negative number. A positive number is going to tell us market bottoms before recession ends. Again, this right here are two instances during the 1930s and 1940s, during the Great Depression, where we actually witnessed significant delays for when the markets bottom, and they were in a tandem. You'll notice that we actually hit an all-time high in September 1929, and we didn't quite get up to an all-time high until 1956. So you can see the markets actually didn't do anything between those two time periods, right? 1956, 49.64, 1929, 31.86, and prior to that, we were pretty much in essentially trading sideways, a lot of consolidation, and we did see quite significant drops of well over 60%, 30%, 14% before finally getting up to all-time highs. So you may argue that I'm cherry picking the data here if I don't include for the first three occurrences, but I also want to mention that this is going to skew the data significantly because of the Great Depression, which was in itself a very, very unique situation in the overall economy. So if I only include for the beginning of 1949, so post 1949, you'll notice the markets have gotten a lot better by anticipating a recession, the ending of a recession by 66 days or just over 2 months. So that's the data that we were able to capture for this analysis, for this data set. That is 66 days or just over 2 months. That essentially tells us the markets are bottoming in 2 months on average prior to a recession ending. So both of these numbers are positive. That essentially tells us what? The market not only tops before a recession begins, the market also bottoms before a recession ends. So the recession timeline is moving slightly more on a delayed basis compared to the market timeline. And that should be the case because markets in general are forward-looking and they try to anticipate what's going to take place with respect to the economy, with respect to the unemployment, with respect to the overall economic activity and GDP and all that stuff. So that's something that I wanted to address in this video. And one last thing that I want to go over, speaking of unemployment. And again, I'm going to be doing more extensive analysis on this as well. And we'll combine the unemployment cycle with the market cycle as well, so that you can actually have a much better understanding and clear perspective on the overall economic correlations here between unemployment, rate hikes, GDP, economic activity, as well as the market. But this right here is where we are currently. I went back to unemployment as far as 1948, so going back several decades worth of data, and the current unemployment reading is 4.3%. Current jobless claims numbers, which we got yesterday at 233,000, and going back over several decades, I was able to figure out the 99th percentile for both the unemployment rate and the jobless claims, and as well as the 5th percentile for the unemployment rate and the jobless claims, and everything in between. And right now, as it stands, current reading of unemployment 4.3, we are in the 22 percentile. So that is still a low reading. So we are somewhere over here at the 22, 25 percentile reading for unemployment, and jobless claims, we're in the 17 percentile. So again, we're somewhere between here because of such a low number. As these numbers increase, of course, we're going to hit the 50th percentile, then eventually a 75, 85, 95, and a 99 percentile if jobless claims increase, unemployment rate increases, and of course, that's going to result in an unemployment situation as well. So that is going to, again, be available. There's a lot of data that we can essentially go over, but that's going to be it for today. Let me know your thoughts down in the comment section below, and what do you think and what do you make of this analysis, and we'd love to know from you guys. As always, make sure that you drop a like and subscribe to the channel. Happy investing. I'll see you all in the next video.